Today we're looking at the short put spread, which is a bullish or neutral option strategy that is similar to selling a naked put, except along with the put you sell, you're going to buy another to reduce the risk. So in this example, which takes place under the ticker V for Visa, the put that was sold had a strike price of 136, and the put that was bought had a strike price of 135 in this example. For the short put spread, the put you sell will always have a higher strike price than the put you buy. Now the main difference between the short put spread and the bull call spread, even though they're both technically bullish, is that for the short put spread, you are receiving a net credit as compared with the bull call spread where you are paying a debit. This is because you are receiving more money for the put you sold than the put you bought. Now with a normal bull call spread or any other debit trade, like just buying a put or call outright, you buy at a price in hopes that that price, the premium, increases in value so that you can sell it at a higher price and get a profit. Now in this case, since it's a net credit, things work a little differently. Right off the bat, your account is going to be credited $29. Now in order to keep that $29, you're going to hope the value of this overall spread decreases. So let's say you're credited $29. Sorry, it's usually written as a negative. And then the value of this spread were to decrease to $20. Okay, so it decreases to $20 because the stock price went up. Then you can buy it back for $20. See, I didn't write these in. And since you sold it at 29 and then bought it back for 20, you just made a $9 profit. So that is the goal of any trade that requires a credit, is that you sell at one price and then buy back at a lower price. So it's the reverse of a debit trade. Now, similar to other spreads that we discussed, the max profit and losses are capped. And again, this might seem like kind of a sad thing because usually when you buy a call outright, the potential profit is unlimited. But in a trade like this, you end up with a higher probability of profit. So that's what you get in return for losing the infinite profit potential. Now, this increase in probability of profit is one reason people trade this strategy. Another reason is because it's overall cheaper than just buying a call outright. However, this does not take into account collateral, which we'll discuss here in just a little bit. I just want to note briefly that your break even will always be the strike of the put you sold minus the credit received. That will be your break even price at expiration. Now, one of the big reasons that this trade is so powerful is because Theta works in your favor. And let me explain this a little further on Options Profit Calculator. This is the exact spread we were just looking at with the 135 put that we bought as a January 25th expiration and the 136 put that we sold. Now, if you scroll down, you can see the net credit we're receiving here. Scroll down even further and you can see your profit and losses on any given day at any given share price. Now, you can also take a look and see how at our 136 strike, that's where we reach our max profit at expiration day. And our 135 strike price of the put we bought is the price where you'll reach your max loss on expiration day. So they're right next to each other because our spread is very close to each other. Now you can of course reach max profit sooner. Your just overall spread has to be further out of the money. Because the stock price starts trading upwards, you can see how you can reach max profit at 146 on January 21st. And it will start curving down, $29, 29. It'll start curving down all the way down to here on expiration day. Now you can also see how Theta works for you. Look, if the price pops up to 138 on the first day and trades sideways, you can see how each day you start getting more and more money because the Theta is starting to decrease the value of that put that the person bought from you. Now, you're not going to gain as much from the Theta because you also bought a put to reduce your overall risk. Because if you have just sold a naked put, your max loss would be much, much higher since the stock price could trade all the way down to zero theoretically. But you're still going to be gaining some due to the Theta decay of the put you sold to some sucker. Now, this only works if you're above your break-even price. If you start going below, you can see how Theta now works against you. Start getting in the money. Each day that passes, you're going to start losing value until you've hit your max loss. Now, if you want to increase the risk of this trade to increase the max profit, you can do so by increasing distance between the legs. So as you can see here, if I take the 135 and maybe move it out to 134, hit calculate. Now our max profit is 49. However, we increase our max loss by doing so, which is going to be now 151. Now you can increase your risk another way, which is by moving everything a little bit more in the money. Now you can do this by going up here. You can take a look how this works by moving it in the money. By going over here, you can move, let's say we move our 134 to 136 and our 136 to 138. Hit calculate. And now you can see that our break-even's higher. Now, we can make more money, but we can also lose more money. We want to keep in mind that the person who bought the put from you can exercise it if it's in the money. That means you can get assigned, and we'll go over that here in just a second. Now, if you want to increase the probability of profit, you just move your overall trade more out of the money. So let's say we move the 136 to 128. We'll do a little bit extreme, and that one to 130, and hit calculate. Now you can see how the net credit's gonna be a lot less here because the probability of profit of this trade is really high. Because you look down here, you can see our break-even's really, really low. Like you could trade sideways and go down quite a bit. So there's a high probability of profit that you're gonna win this trade. So the net credit you're gonna receive is gonna be $7, it's gonna be significantly less, and the max you can lose is gonna be significantly more. So that's just what happens every time you enter a trade that has a high probability of profit. You're going to see this kind of pattern. Now let's take a look at assignment and learn a little bit about collateral. So every time you enter a short put spread, some of your capital is going to be set aside in case you are assigned. So let's look at our earlier example where we bought a put at 135 strike and sold a put at the 136 strike. Now if this put, the short put, gets in the money, the person who bought this put from you can exercise, meaning that you are quote unquote assigned. So you are obligated to buy 100 shares of the underlying at $136. Now usually your broker is going to automatically exercise, if you don't have the capital to handle it, going to automatically exercise the put you bought, meaning you sell 100 shares of the underlying at 135. So if you bought 100 at 136 and sold 100 at 135, you're going to have a loss of $100. When you enter this trade at the very beginning, your broker is going to take this $100 and set it aside, and it's going to be called collateral. Sweet Lord, I hope I spelled that right, if you can even read it. And that will be your total loss. So your max loss that we're talking about earlier does not include if you are assigned. It only includes if the stock price goes down without assignment. So to determine how much collateral is going to be withheld and how much the max loss will be if you are assigned, all you have to do is take the difference of your strike prices and multiply it by 100. So in this case, the difference between these two was $1. Multiply that by 100, that's $100. Now we're talking about earlier how if you spread out the legs, you can increase your risk and therefore increase your max profit. Well, keep in mind that as you spread out these legs, the amount of capital you have to put aside is going to be greater. And also keep an eye on the stock price, and if it starts moving to a point where your short put is in the money, it may be a good idea to close the trade. Thanks for watching. I'll be releasing videos usually just once a week on Saturdays, contrary to what I said before, but that's probably how I'm going to do it. Feel free to subscribe if you want to watch more videos like this. Otherwise, I love you.